The market interest rate has gone below the one-digit level, with the Treasury bills posting a 10.7518% from the 364 Treasury bill. That translating to a 9.095% in net return investing in the one-year Treasury bill. That one-year Treasury bill is the one that is used to give the market interest rates. And therefore, the Treasury bill sensitive money market funds have started following suit. And for that reason, we are seeing declining trend in the returns that are being posted by the money market funds. However, as per the mandate of the fund managers, we still have fund managers who are getting out in the market and getting alpha returns to their members, as we shall be seeing later on through the schedules that we'll be posting. At the same time, the central bank has released the CBR rate, which guides banks on their lending rates. And the CBR rate has been reduced by 50 basis points to a low of 10.75. And that is expected also to reflect in the lending rate by banks, and it shall also have an impact on the money market funds, because as we shall be seeing later on in our schedules, the money market funds have taken a huge shift from the government securities and the corporate bonds to take advantage of the fixed deposits and cash and call accounts with the banks. Because as we all know, commercial banks are intermediaries between the savers and the borrowers. And the fund managers on their side are literally aggregators of money, pulling money together from retail investors and making that money available to the commercial banks for lending to the borrowers. And we shall be looking at the reasons why your fund manager has taken that bias towards the fixed deposits in order to cushion the returns that they are giving us with the money market funds. We have also witnessed the government holding huge investments in the treasury bills, and as is expected, most retail investors have wondered why the government will invest in billion of its own money through its agency to itself, and what it amounts when the government makes interest out of its own money. We'll be looking at all those and further details after 3 seconds short break, so don't go away. In the meantime, give us a like to this video and engage us in the comment section. See you after 3 seconds short break. Welcome back, and as per this schedule, the market inflation rate has remained at 3.3%, as is expected by the regulator to remain at the middle of the range between 2.5 and 7.5, and that is meant to give us stability on prices. On the other hand, the auction of the treasury bills posted the market interest rate at 10.76%, which when subjected to a withholding tax rate of 15% of 1.61%, that leaves us with a net market interest rate of 9.14%. As expected, the interest rate posted by the money market fund has also started following suit, with Equity Bank's money market fund hitting a 6% net return for its money market fund. And because as earlier we had stated the rationale, where the 3.3% that is given as the inflation rate does not reflect the actual inflation from the market, then the 6% net return that we're getting from that money market fund may not be protecting the capital against real inflation. ZD money market fund has also started tumbling down, and it has hit a low of 9.79% in its net return, having posting an 11.52% inclusive of the withholding tax. The week saw Genki's Capital and Britam's money market fund be the gainers of the week, with Britam pulling itself from the bottom of the performance list and attaining acquiring a number in the top 15 money market funds, and Genghis Capital GenCap Hela money market fund weathering the storm and acquiring a position in the top 10 money market funds. As on the other side, as indicated, the losers have remained Equity Money Market Fund, and ZD's tumbling has also placed ZD as one of the losing money market fund in the period. As per our schedule today, Saiton Money Market Fund stood as number one, posting a 16.25%, that is giving us a net return of 13.81%. Etika followed closely at 15.31% and a net of 13.01%. And that closed the list of money market funds that are giving us a net return that is above 12%, and this includes Ndovu Money Market Fund, an online money market fund, and a GovCap Money Market Fund, which we have not included in the list because we are reviewing that money market fund, and once we have got all the details, we'll start featuring it in our list. Lofty Carbon Money Market Fund stood at 15.24%, hitting at 12.95% in net return. Kuza's 15.02% gave us a 12.77% net return, with Havocap giving us a 14.35%, that realizing a net return of 12.20%. And we have our own Mali Money Market Fund, which has outperformed ZD's new ZD Money Market Fund, where Mali is now giving us gross return of 12.47%, that is a net of 10.60%, with ZD at 11.52 and a net of 9.79%. The money market funds being responsive, highly responsive or highly sensitive to the treasury bill market, these money market funds have continued to give us returns that are competitive compared to what is being posted by the treasury bills, and for reasons that we can peg to the CBR rate, which now stands at 10.75%. The CBR rate, that is the base lending rate that is given by the regulator to commercial banks, and the commercial banks are supposed to add either 4 up to 4 basis points, 4% on top of the CBR rate to determine their lending rates or loan interest rates. Above that figure, banks are also allowed to rate or determine the interest rate that they are charging our loans on basis of risk exposures per customer. And that gives us a rationale why most fund managers keen on giving competitive returns to their members have shifted their investments from the government securities and corporate bonds to the commercial banks, fixed deposits, and cash and call accounts. And as per this schedule that we have highlighted, it is considerably notable that the fund managers have shifted that investment, much of the investment, to the fixed deposit category, with the Lofty Carbon having over 90% of the entire fund invested in fixed deposits and cash and demand deposits. As noted, Saitons has 48% of its overall fund sitting with the fixed deposits. We have Kuza having over 51% in fixed deposits and cash accounts, Avocab having over 76% of its fund in fixed deposits and bank balances. Etika has 41% in as per this schedule, but we have established from the recent fact sheet that Etika is holding 60% currently of its funds in the money market funds in the fixed deposits and cash and demand deposits. That is comparable with the previous holding of 49% in government securities, and that is a show that a lot of the fund has been pushed to fixed deposits in order to continue guaranteeing the investors the high return. That is also informed by the fact that, as we have seen, the government has been collecting huge taxes through the housing levies, and because of reduced constructions of the affordable housing, a lot of that fund, a lot of the collected amounts totaling to billions, and to be precise, the recent investment of 46 billion into the treasury bill market. I leave the comment section open and you tell me about what are your thoughts about the government investing its money in the treasury bills. Lastly, as we continue observing the declining interest rates as posted by the money market funds, but also appreciating the fact that the top 5 money market funds have continued giving alpha returns to their members owing to their ability to shift a huge investment from the other segments to the fixed deposit segments, we have also noted that the fixed income funds will continue being the second preferred and most recommended option to the money market fund, because the fixed income funds are leveraged on long-term instruments in the bond market that were giving huge coupon rates or high coupon rates, and those coupon rates will keep on averaging higher the returns that we are getting from the fixed income funds. And therefore, it's advisable at the moment you consider having a money market fund on one side and a fixed income fund at the same time, because the two investment vehicles give you the same experience. The flexibility, accessibility, and liquidity of the two funds give you the same customer experience. Thank you for watching and see you in our next video.